Hey guys, welcome back to my YouTube channel. You're with me, your friendly neighborhood millionaire. So today's topic is about what is forex, and I will tell you what it is in simpler terms. I know there are more complicated ways of explaining what forex is, but I feel if I use the simpler terms, it will be much better to understand. So basically, what forex is comparison or comparing of two currencies, which one is stronger, which one is less strong. So currencies are always paired in two. You can have USD slash GBP, which is US dollar versus the British pound, or you can have US dollar versus the euro. Okay, versus the euro. Okay, so there are two participants in the market. There are buyers and sellers. The buyers always wish for the market to go to the upside, while the sellers wish the market to go to the downside. So there are different people that trade forex. These are hedge funds, your banks, and your brokers as well. Those trade forex. So how does it work per se? So buyers, when they buy the price, they buy a certain currency. Let's say we are comparing two currencies, which is US dollar versus the GBP. Okay, so already there are two currencies involved. Okay, so that means in this case you are comparing the US dollar against the pound. Which one is stronger? If the US dollar is strong, in this case, the market will be trading upwards, going in an upwards direction. Okay, if the pound is stronger and the dollar is weak, the market will be going downwards. Okay, but I'll show you the graphs later on how the market moves. So usually there are two entities that are involved in the market, as I explained earlier on. Okay, they're buyers and sellers. The buyers hope the market goes up because why? They're buying at a cheap price in hopes that the market shoots up. Let's say you bought, it's just an example, you bought $1 is equivalent to £2. So you're hoping to buy the same. If the price is here, which is at $1, then when it reaches here, it will be at $2 or £2. $1 is equivalent to £2. That means the buyer will hope to get it at $1 and sell it at a higher price. So they're hoping that the market goes to the upside, while the sellers, they start the price on a higher part in hopes to push the market to the downside. Okay, so that's basically what happens, and all this price movement is like a tug of war. So you have your buyers here, you have your buyers on the lower side, you have your sellers on the higher side. Okay, so price is on the sides here, this side. Okay, so you can have your 1, you can have your 2, you can have your 3, you can have your 4, you can have your 5 there. So always when price starts, let's say at 1, the buyers that are below here and the sellers, which will represent by an S, the buyers are hoping they push the market up. The sellers, they hope they push the market to the downside. So there's always what we call a tug of war in price, and that tug of war is represented by what you know as candlesticks. Okay, there's another course that you can follow on what candlestick means and what they represent. Otherwise, all candlesticks have, if they are a seller's candlestick. It will have an open right here. It will have the highest where it has gone and the lowest where it has been, and your close right here. So we'll further that into more details. All you have to do is follow my channel and I'll tell you more about this. But if we go to let me show you the charts. Okay, if I show you the charts, we go to the charts. For example, here, this is gold. So let me go to a currency pair. I think that will be much better. Let's go to pound US dollar. Sorry, my charts are mapped up because I was analyzing. Okay, so if you go to a 1 hour chart, if you zoom this out, there's price movements. Okay, so when you see something like this, these movements here, from here, let me change the color of this. From here, you see, all the way to here, the sellers push the price down. Buyers set back in, they tried to push the price up to this point, but still it went to the downside. Okay, so when the sellers are in the market, they hope the market goes down. When the buyers are in the market, they hope the market goes up. That's how I can simplify forex trading. There are a lot of things that you would need to know, but this is just a more of a basic understanding of what forex is. So you might ask, but how do you make money? So we make money in such a way. Okay, we make money in such a way. So let's say, for example, according to my analysis, price was here. Then I anticipated that the price, because there's a rejection here, there's a zone here that you will learn about in other topics. Because there's a zone here, price will definitely go up. So I can buy at this low price. Okay, right here, I can buy at this price right here. You see, so let's say I bought the pound at 13.050. Okay, to put it in perspective, we'll just say I bought the pound at 1 pound would have given me let's say $5. Okay, so when I bought it here at this point here, when I bought it here at this point, 1 pound would have given me $5. It's just an example. Okay, when price moved to here on this top part, that means I would have profited, because at this point, for my 1 pound, I would have gotten $5. But because it moved, now I'm getting my 1 pound, I'm getting 10. So all that price movement from down here all the way to the upside to this part here is my profit. That's how simple forex trading is. It's all about anticipating where the market will move, or how strong price is, or how weak price is. So that's the simplest I can explain. Otherwise, if you like this video, hit the subscribe button, leave a like, leave a comment. The next video, I'll definitely talk about what candlesticks are and what you need to know about forex really, and how to analyze the market.